So welcome back to part 3. This is where I just go through some macro, and obviously the main emphasis is going to be what's going on with Israel at the moment. So when we take a look at the macro situation at the moment, usually it's all inflation, it's interest rates, etc. Now, of course, there's more and more sort of political tension coming around the world. Of course, Israel's now started the second phase, and they've started their offensive going into Gaza, and the things could escalate a lot more, because there is a lot of tension in that region naturally, especially against Israel. So it's going to be, a matter of how things go and how quickly. Don't expect this to be over quickly. This is going to go on for months and certainly into 2024, I would say, especially when you listen to sort of the rhetoric coming from the Israeli government. And I suppose one thing that could sort of deter other countries from getting involved is the fact that the US are supporting vocally as well as military Israel. So that may just make some of the other countries a little bit more reluctant to join in. Not necessarily the militants, they may still get involved in those areas, but again, the US have demonstrated that they're prepared to take them on if necessary. So if we look on sort of towards the end of last week, especially late Friday afternoon, the markets began to react with expectations of Israel going into Gaza. We saw gold have a massive rally. It went up to 2019 something, almost 2020. Where that's going to open this week is anybody's guess. And of course, watch out for oil as well, because we could see a big spike there, just because of disruptions in that region. So as we're seeing that sort of geopolitical situation continue to deteriorate, there's second war. Is it going to be a third one, or other countries going to get involved? The world is becoming a much more dangerous place after we had a really good period of just everyone sort of almost getting on. I wouldn't say completely, but not far away from it. The tension was more about trade rather than sort of becoming actual conflicts. So as I said, so the markets began reacting on, with gold rallying, oil rallied towards the close as well, and where's it going to go next? And the thing for me now is going to be the potential for disruption to supply chain issues in the region. And if that does happen, then that's certainly going to prevent inflation from falling, and it's possible that it could actually spike. If this really picks up momentum in that area, I mean, there is a chance that oil could go back over $100. Now, remember, that is just my view. Don't take that as any recommendation. That is just what I'm seeing the potential for. I'm not saying it's going to do it. But of course, all of this is likely to derail the central bank's efforts to get that inflation back to 2%. When, okay, it was doing it slowly, but it was going in the right direction, and they were getting close to sort of being able to see the light at the end of the tunnel, and perhaps that's starting to disappear again. And of course, we do have some central bank decisions this week. Bank of England, and obviously sort of the Fed, and that's going to be an interesting one. And then we've got all the employment data that comes out at the beginning of the month. But for me, that's going to take sort of second place to what's going on with Israel, and how aggressive they are or aren't as they go in. Are they going to take it steady? It seems as though that is possible. but you know, you've got to expect for volatility in the markets. And for me, data will come second to what's going on there. And of course, potential for inflation. Is that going to again put pressure on the central banks to raise interest rates? Again, if it's supply chain issues, it's not consumer demand. So why punish the consumers when they're not really got any say in the prices that they're being charged in the shops? And of course, some of that is still corporate greed as well. Overall, maybe it's moving recession slightly, but there's still potential for recessions. Could it actually take the US from being sort of a potentially a soft landing to a recession? Again, at least now they've got a speaker so that they can actually start to get things passed again. And those unemployment levels are a question as well. So when we look at the FOMC, it's likely, you know, the expectations at the moment is that they're going to pause despite the strong data. And this is partly due to household disposable incomes beginning to shrink, their savings becoming drained, and of course, you know, it depends where you are earnings wise, of course. And of course, if stocks continue to fall, then that household wealth is going to take a hit as well. You know, it's all right having all this sort of wealth on paper, but if you can't actually lock any of that in, then it doesn't make that much difference. And you know, that could start to knock consumer confidence. Then on top of that, you know, do they need to hike again when they haven't seen sort of the full impact of all the hikes that they've done so far? Plus, we've got these tighter lending conditions, which effectively act as another rate hike anyway. And then on top of that, you've got all the student loans that are having to be repaid again. And you know, when it comes to loans, keep an eye on loans, you know, sort of credit card, car loans, etc. And you know, those mortgage and car loans now for the new ones are above 8%. And of course, many that have been on those fixed cheap parts of their loans will be coming out of them soon, and they're going to have to pay market rates. So again, that is going to impact disposable income. And then, you know, when you look at the UAW, you know, the auto workers, they managed to, the union did well for them, I would say. They've won the battle against the car manufacturers, because it seems now that all three of them are agreeing to a 25% wage hike for its members. And good on them. And you know, from what I've read, it does seem as though they have potentially been a little bit sort of undervalued for some time now. So that may just be more rebalancing. It's not necessarily again going to spike inflation. So you know, that's pretty much it for this area. So that's my macro. Focus is just got to be on what's going on geopolitically at the moment, and it's going to override data, economic data for sure. Okay, so if you stay with me for part 4, I'm going to do some analysis, and then we can see where the markets are likely to be, where they could break, etc., as we come into this new week. So we offer newsletters, we offer workshops, 1-week courses, our comprehensive masterclass that's really going to help you. You know, apart from gaining all that fundamental knowledge, you get to spend 20 trading sessions with me, practical sessions. So you know, that's you know, I'm not saying I'm going to turn you into a massive trader in 20 sessions, but you know, getting that sort of feedback from me, that insight from me, is valuable. Now, other things that we offer are trader mentoring. We consult to companies on FX and commodity exposure. Of course, we provide a massive educational content to individuals, exchanges and brokers. If you feel underfunded, why not give the trading challenge a go, and see if you can get that funded account. You know, maybe you're underfunded, maybe you don't want to risk your capital, which is quite understandable. And of course, one of our courses now includes a free attempt at the trading challenge. If you would like to find out more about anything, then contact us at info@symaxfintech.com or directly to me at chris.tubby@symax-int.com. Okay, so now we're going to go into the technical analysis section. So I hope you join us for part 4.